The Sell America trade is back on Moody's downgrade. What's safer than Treasuries? Hello, member super savers and bond course fans. I hope you're healthy and well. So a few days ago, Moody's downgraded U.S. Treasuries from AAA to AA1, their equivalent of AA+, as we discussed in this video from this past weekend. Link below for your convenience. Treasuries have now lost their last AAA rating from the top three largest ratings agencies. Standard & Poor's, Moody's, and Fitch now have Treasuries as AA+ or the equivalent. AA+ and AA1 are still their second best ratings, by the way, just for a bit of perspective. Nonetheless, this was the message we posted early yesterday morning in our member zone. At 6:35 a.m. Eastern Time, the 20-year and 30-year are both above 5% after the Moody's downgrade, and the 10-year is above 4.5%. And headlines like this Bloomberg one were all over the papers. Sell America is back as Moody's pushes 30-year yields to 5%, which naturally started worrying some of you. From one of our members, does the downgrade mean Treasuries are no longer the safest investment in the world? And if there are any higher rated bonds out there, it means that they are now the safest investment in the world. So with that in mind, here are the three topics that we'll be covering in today's video. 1. Are Treasuries still the best investment if you want both safety and liquidity? 2. What are the options if you want to hold AAA rated bonds? And 3. What's our perspective and what are we doing? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Are Treasuries still the best investment if you want both safety and liquidity? So after the downgrades from AAA to AA+, Treasuries may not be considered as the safest investment in the world anymore by our ratings agencies. That said, they should still be quite safe overall, even with their somewhat diminished AA+ or equivalent ratings. In fact, and this may surprise some of you, the large ratings agencies tend to apply a different, and many would argue, overall stricter standard to public finance issuers, like the US, than they do to corporates, such as private companies, banks, and insurers. And this means that Treasuries may still be safer than straight AAA-rated corporate bonds. Let's look at two reports from Standard & Poor's to show you what we mean. Those in the industry sometimes consider Standard & Poor's, S&P for short, to be the gold standard among ratings agencies, by the way. So both these reports are called as a starting point, default, transition, and recovery, 2024, and so on. But one is for U.S. public finance issuers, again like the U.S., and the other is for global corporate issuers. The titles are long-winded and technical, but the reports essentially analyze how many issuers with a certain credit rating at issuance defaulted on their debt at some point later on, which is basically a way to evaluate how accurate S&P's past ratings were for these issuers. And let's look at the table for U.S. public finance, USPF issuers here first. Now, S&P has the U.S. rated as AA+ at the time of this taping, but the analysis does not dive into this level of detail. So we have to look at this row here for AA rated issuers overall. And what this table here tells us is that in the past, if you had bought a bond from a U.S. public finance issuer, such as a state or municipality that was rated AA by S&P at the time of purchase, then the likelihood that this bond would have defaulted after 14 years was 0.04%, or 4 in 10,000. Of course, no one can predict the future, and I don't have a crystal ball either. But based on these S&P statistics here, this means that the likelihood that the U.S. might default on its bonds in the next 14 years would be 0.04%. Again, a 4 in 10,000 chance. That is worse than the perfect 0% default rate for AAA rated public finance issuers here. But still much better than the likelihood of default for a U.S. corporate with a comparable rating. Even a top-rated AAA U.S. corporate issue has a much higher default rate of 1.01% than a AA-rated public finance issuer with its 0.04% within 14 years after purchase. And with a AA rating, U.S. corporate issuers come in at an even higher default rate of 1.26%, again versus a AA-rated public finance issuer with the 0.04% that I just showed you earlier. And if you think about it, this difference may not be so surprising after all. If a private corporation gets into trouble, lenders, clients, and employees may just walk away. If you're a public sector issuer, though, such as the US, your population can't walk away that easily. And if worse comes to worse, you may just be able to ratchet up taxes enough to avoid going bankrupt. As we so often say, past performance is not indicative of future results or events. But as it stands, we may not have to sell our treasuries in a panic quite yet due to safety concerns. And that even more so if we look at liquidity, because treasuries have so far retained their undisputed place as the most liquid investment in the most liquid financial market in the world. SIFMA, the Securities Industry and Financial Markets Association, publishes regular reports about securities issues and trading in the U.S. And this table shows you that in the first quarter of 2025, U.S. Treasuries, UST, accounted for a staggering $1,048 billion of average daily trading volume, or ADV, 70% of the average daily trading volume in all bonds in the U.S. In contrast, corporate bonds only traded a fraction of these numbers, with an average daily trading volume of $60.9 billion, a mere 4% of the total. So, if you can live with the fact that treasuries lost their last top rating and may be a bit more risky than in the past, and you want to keep investing in the most liquid type of security you can buy, then you may just want to stay with treasuries. But more about my personal perspective at the end of this video. Let's first have a look at what would be the alternatives to treasuries if you're looking for safety above all else. What could you invest in if you want to have at least a part of your portfolio in AAA rated bonds? What are the options if you want to hold AAA rated bonds? As we just discussed, AAA rated corporate bonds from private issuers may not really be safer than treasuries, even with their downgraded AA plus equivalent rating by Moody's. Plus, there are really only two corporates left with a AAA rating from both Moody's and S&P in the US, Microsoft and Johnson & Johnson. There used to be more top-rated companies in the past, but most of them decided at some point to finance themselves with more debt and less equity because they liked the lower cost for issuing debt versus the higher expectations for returns on equities. Which means that if you want to keep some of your money in AAA rated bonds that are really presumably safer than treasuries, you will need to stay within the world of public finance issuers based on S&P's default, transition, and recovery analyses we just shared with you. The default rates for public finance issuers are lower than for corporates with the same letter rating. And this leaves you really with two options. Option 1. Invest in AAA-rated U.S. muni bonds that fall under public finance and that should have been analyzed by the ratings agencies according to the same criteria as U.S. Treasuries. There are quite a few of these top-rated U.S. muni bonds available for purchase. For example, if we go on E-Trade at the time of this taping, there are several thousand muni issues from very different issuers with a AAA rating from both S&P and Moody's. That said, quite a few of these offerings will be very small and not really liquid. You can see this from the empty circles and insufficient data notifications in the market check column. Now, before you rush and switch all your savings into munis, please consider three things. First, while there are taxable munis, most investors purchase tax-exempt munis for exactly this tax privilege. And to fully benefit from it, you generally have to be in the highest marginal tax bracket. Second, as we just touched upon, munis are generally not very liquid, and with small issues, you may, in the worst case, even be stuck with them until they mature, unless you're willing to sell before maturity at an often steep discount. And third, yes, these munis are currently rated AAA by both S&P and Moody's. But no one can say what would happen if the U.S. were to actually default, and all these munis may be impacted as well. As our Diamond NestEgg regulars have heard me say often, any real default on U.S. Treasuries would most likely have severe repercussions all over the country, and it's something we really hope we won't see in our lifetime. Bond beginners, folks, please refer back to Module 9 on municipal bonds and Module 10 on corporate bonds if you're considering going down either of these routes, as muni and corporate bond investing can get fairly complex pretty quickly. If you're not in our bond courses, you can check out these muni and corporate bond videos linked below in the first pinned comment. Option 2, which may give you peace of mind if you really want to buy some of the safest investments available, and munis are not a good fit for you, are bonds issued by foreign governments and supranational entities. If they carry a top rating, they should also have been assigned by the ratings agencies based on their public sector criteria. And even in the worst case of a hypothetical U.S. government default, as foreign issuers, they could maybe remain a bit more insulated from any domestic fallout. Let's go on E-Trade again and see what's available on their platform. And it should be a similar offering at Fidelity from what we can see, although their filter function didn't work perfectly when we tested it out yesterday. Foreign sovereigns are listed under corporates. So the way I found them on E-Trade was to filter corporate bonds for those that have AAA ratings from both S&P and Moody's. And what I got was this list of 200 plus bonds. This list includes Microsoft and Johnson & Johnson as the two remaining U.S. corporates with a dual AAA rating from both agencies. But these are easy to skip over. And what we see is that there is a certain range of foreign names to choose from, including the European Investment Bank, a supranational organization, or Kreditanstalt für Wiederaufbau, KfW for short, essentially an agency that has an explicit written-in-law guarantee from the German government. All these bonds on the list here are registered in the U.S. and can be bought and sold like any domestic bond. They're also denominated in U.S. dollars, which means that you will be repaid in dollars. The advantage here is that there's no currency risk, which at the same time means that if you're trying to diversify your exposure into foreign currencies, such as the euro, these foreign bonds won't solve that for you. Here again, note the empty circles and insufficient data notifications in this market check column, meaning that these bonds are not very liquid. So to summarize, if we look at the historical default rates from S&P, even Treasuries with a downgraded AA plus rating carry a lower default risk than AAA rated corporates. Not to mention that Treasuries remain at a distance the most liquid investment in the most liquid financial market in the world. If you still want to buy some public sector bonds with the very best ratings that could indicate an even lower probability of default than for U.S. Treasuries, U.S. munis, or foreign public sector issuers, such as sovereigns that carry a AAA rating from both S&P and Moody's, may be an option. Both Fidelity and E-Trade, for example, give you access to such bonds that are registered in the U.S. and denominated in U.S. dollars. However, they will generally be much less liquid than U.S. Treasuries, bringing us nicely to the next section of this video. What's our perspective, and what are we doing? Safety is important, but not in isolation. The money that we currently have in Treasuries, we keep there because in our opinion, Treasuries have been and continue to be the safest and most liquid investment in the world. It also doesn't hurt that interest earned on Treasuries is exempt from state and local taxes when held in a normal taxable brokerage account. But let's set aside the tax aspect for this discussion and focus on safety and liquidity. A portfolio of AAA munis and foreign sovereign bonds may have a better credit rating than Treasuries and may even be a bit safer from a credit rating agency's perspective. But the lack of liquidity is a big negative in my mind as a bond investor. And it seems that some in the market feel similarly because this Sell America trade, it didn't last very long. 12 hours later, the 20 and 30-year Treasuries we're slightly below 5% again. And that's also why we posted this member message a few hours before markets opened yesterday, because most of the 5% or close to 5% Treasury yields that we've seen recently after some screaming headlines on our screens don't really last very long. Here's where Treasury yields ended the day yesterday. Now, this is not to say that we won't be seeing more 5% plus yields in the coming weeks, months, or even years as tariff, inflation, and interest rate worries continue. Market uncertainty and volatility are fact of life, but as our Diamond NestEgg regulars know, we are not in the Sell America camp. As I've talked about often on this channel, the most valuable companies in the world are American. The most powerful financial market is American. And the most dominant currency is the US dollar, also American, despite what some headlines will try to say to the contrary. This is not to promise that it will always be this way. Even the Roman Empire fell after a few hundred years, but this is the way it looks now, in our opinion. So we'll keep auto-rolling our T-bill ladders, parking our excess cash in VUSXX and SPACs with their underlying investments in U.S. government paper and dollar cost averaging into predominantly U.S. equities. But as I always say, everyone's financial journey is different. What about you? What are you doing with your personal portfolio? Are you looking for Treasury alternatives? Or perhaps have you even found some already? Or are you just watching the market for more 5% Treasury opportunities? Drop a comment below and let me and the community know. And if you fall into the less concerned, more opportunistic category, then check out this video here on our bond courses to learn all about bond investing and building out a bond portfolio while rates are still attractive. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of May. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or Bond Masters individually. And come join our next live member Q&A on Thursday, May 22nd at 7 p.m. Eastern Time, 4 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.